As you probably know, taxation of capital gains is changing, and what does it mean to you? Well, under the old regime, only 50% of your profits or capital gains was taxable. That was the inclusion rate. Under the new tax regime, which is kicking in on June the 25th, 2024, any profits that you will make on either selling your portfolio, any profits over 250,000, but also investment in real estate, or if you own a cottage or a cabin and you decide to sell, any profits of over 250,000, the inclusion rate will go up to 67%. All it means is that 67% of your profits over 250,000 now will be taxed at your marginal tax rate. Initially, these tax changes were introduced as taxes on the rich, so to speak, because it is true that the inclusion rate is changing only on profits over 250,000. So anything below 250,000 in profits will be still included under the old inclusion rate, which is 50%. But any profits over 250,000 would be taxed at the new rate, which is 67%. But in reality, most Canadian families, or any families that have assets outside of RIF or a TFSA, any substantial portfolio or any properties, investment properties, or even recreational properties, cabins, cottages, will be caught in the new tax scheme or in the new tax increase through deferred estate taxes. Because when somebody passes on, all of their assets are deemed disposed of and taxes are payable. Corporations and trusts are now, under the new changes, the first dollar of capital gains is taxed. The inclusion rate is 67%. So what are your options? We all know that we pay enough tax, and now with the increase to the inclusion rate, there'll be taxes will be actually increasing in the future years. Well, there are a couple of solutions. One is to start selling assets strategically along the way. The other solution that is readily available is to look at an estate bond, establishing an estate bond either personally, or if you have a corporation, you could establish a corporately owned estate bond. And essentially, a estate bond is the only way to transfer assets to the second generation on a tax-free basis. If you were to look at a corporate estate bond, you would actually be removing assets from your corporation completely tax-free. So what is an estate bond? It's an insurance strategy. Essentially, it's an insurance contract with an investment vehicle within it, and you would be moving assets from taxable environment into tax-free environment. We are providing a couple of links down below to videos specifically on estate bond. There'll be an estate bond personally owned, but also a corporately owned estate bond on the other side. Thanks for tuning in today. Please let me know if there are further questions. Feel free to shoot me an email. Please like the channel, subscribe to the channel, and see you next time.